All right, well, welcome back to our December economic update. I'm John Cleaver, partner and senior financial advisor with Beyond Wealth Advisors. And with me again is Dennis Bacon.
Chief Investment Officer, Beyond Wealth Advisors.
And we're here in the month of December. Believe it or not, this is the last edition of 2022.
No, it's kind of crazy.
It's been a pretty normal year, just kind of, here we go, nothing new, right?
John hasn't been paying attention.
I've been paying very close attention. It's been, every year presents its own unique challenges, but also opportunities.
Oh.
And 2022 has been no different. Now, a couple months ago, it didn't feel like things were going to maybe end up too good for 2022. But things have turned a little bit better. We're in a little better spot than we were maybe 2 months ago. What's happened?
Well, it's been, there's been a lot of stuff happen. The biggest thing that's probably happened is the Federal Reserve has now had almost 3% increase in the Federal Reserve funds rate. This is starting to have a little bit of impact. Also, we are looking forward to 2023 with a split government.
Right.
The House of Representatives will be Republican. We're starting to see just ever so modestly uptick in unemployment. Very modest. Not enough to really say it's a trend yet, but very modest. The other thing is the manufacturing index has went negative.
Right.
So it's showing contraction in the economy. That's first time that's happened. China has flipped a month or two ago, and Europe has been there for quite some time. So that's been kind of a little bit of a change that's been going on, probably a little bit as a result of what the Fed's been doing. All sectors of the housing market are still down, except we had a blip in November where new home sales were actually up. But that may have been just a little bit of a lag effect, and most people feel like. Inflation was only up 0.3%, but remember, 1 month doesn't a trend make on inflation.
That's
so
right.
A lot of factors impact that. So they tend to be readjusted later. So that's kind of what we've seen and what's been happening. Some of the actions is taking place.
Right. So with that news, some good, some bad, but the markets have responded relatively favorably the last 2 months. In fact, we've seen the bond markets improve across the board. The dollar weakened a little bit, which has been good for both international and emerging markets.
Right.
And for the most part, equities. We've seen some recovery. Certainly in October, we bounced back pretty strong. In November, offered some pockets of growth as well. So we often talk about the difference between the economy. You just shared a bunch of economic things that have been happening recently, and then we talk about the market. So why is the market performing better?
Well, there's a couple of reasons. One is we kind of were predicting the last quarter would probably be fairly good, kind of a little bit of a rebound. So a little bit of a rebound effect. Post-election, usually after an election, there typically tends to be a little more certainty, and so tends to do a little bit better. But probably the biggest thing is with the Fed raising their rates, I think that the investors are convinced that the Fed is going to probably drive us into a recession of some sort, at least a substantial slowdown in economic activity. That hasn't really kicked in quite yet, but we're starting to see signs of it. And as that happens, they know one of the tools for combating a recession is lowering interest rates. So the traded bonds, as opposed to the Federal Reserve rate, are actually building in the fact that we're going to have a slowdown in the economy. Thus, interest rates are going down, which causes the value of the bonds to go up. So that's probably one of the biggest factors there. The second is, I think the dollar is decreasing in value by about 5% in the month of November, which means if you held a position in a foreign stock or foreign bond, it went up 5% because the dollar went down 5%. So you kind of get a little bump on those type of investments. And so that's been important. On the equity markets, we've seen a real shift to the value side, substantially to the value complex. Industrials, metals, financials, those have all continued to do really well. Now, on the other side of the value side of the market, the oil and energy sectors have not done well, and healthcare has lagged a little bit. with the growth side of the whole investment complex has been kind of right in the middle. So we've seen some rotation in there, which I think has given us a lot of activity going on in the market. Commodities, again, it's kind of the same story. If you own metals, you were doing good in commodities in the last month or two. If you own energy, not so much, because the barrel of oil has gone down, with agriculture being kind of right in the middle.
Right.
So kind of trending okay. Kind of, it's really a little bit more of a better inflationary indicator right now, probably.
That makes sense.
Yeah.
So one of the things we've heard a lot through this last few months, 5-6 months, is that at some point inflation's got to come down, right? The Fed's actually trying to pull inflation down. So this is a two-part question that tees up the next topic. So one, is inflation starting to roll over? In other words, has it peaked? We hear some conversation out there that maybe inflation's starting to peak. And then ultimately, what does that mean in terms of a brighter outlook for 2023, even though we may have some recessionary undertones? Does that make sense?
Right.
Yeah.
I think I understand. I think on the inflationary side, I think that what we're looking at right now is we're starting to see it probably is peaked more than likely, but it's going to take it a while for it to come down. And no matter what you say, when you're at 7.7% inflation, which is what it was for the last 12 months, that's still almost 2.5 times what the federal or almost 3 times, over 3 times what the mandate is for the Federal Reserve. So we're still well above where we want to be, and the current interest rates are well below the inflationary rate, and usually they have to get closer. Right. So what we're looking at is probably another 6 months of really a lot of turmoil and doing that. Most of the pain will come towards the end of that. And what we're really kind of thinking is that at the end of next year, we should eventually have that more rosy outlook. Right. But I think between now and then, we may have a pretty tough summer. I don't know exactly the timing, but it could be that summer time period will be really tough from a job standpoint and from a deceleration of the economy. But we don't really see a deep, long, hard recession like we've seen sometimes in the past. Yeah, but I do believe that there will be some more difficulty, and most of that will come in the jobs area. I still think we'll be at 4.5 to 5% unemployment by the middle of next year. Probably after Christmas is when we'll probably start seeing some of those things. We're already seeing some anecdotally right now. Makes sense.
All right. Wow, that was a lot. We've come a long ways in 2022.
Yeah.
And we hope for we'll say a brighter 2023. And
I think so.
With that, we want to wish you a Merry Christmas, a Happy New Year, and we certainly appreciate the opportunity to bring these updates to you. As always, this time of the year, if you have questions, be sure to reach out to your advisor. If you're seeing this for the first time, give us a call. We'd love to chat. And with that, anything else?
Merry Christmas.
All right.